Recent changes to the rules of emigrating from South Africa are a driving force behind the tax emigration of retirees. The changes also affect second-generation South Africans who have been living abroad for many years. Experts say they are witnessing an increase in the number of tax emigrants. They say in terms of the old rules, there were certain processes once emigration had been approved. Now, these included the remittance of up to 20 million rand of capital per year per family unit by an authorized dealer with an ordinary tax clearance. The South African Reserve Bank approval was required for all larger amounts, and then a more stringent tax clearance process was followed. Over and above that, income on South African assets such as interest, dividends on listed and unlisted shares, property rentals and annuities were allowed to be remitted on an unlimited basis. However, from the 1st of March, these rules changed. Now, it is 10 million rand per person and not 20 million rand per family that can be remitted. To get a better insight about this story, we're now joined by an independent tax and exchange control expert, Hugo van Zyl. Hugo, very good evening to you. Thank you so much for joining us. Welcome to the Globe.
Thank you, Simphiwe. Much appreciated.
In terms of the trends of, the emigration of retirees in South Africa, what are you saying? I mean, what are you seeing?
So interesting, some of those retirees are now passing on, and they now have children that were born outside South Africa, some of them born in South Africa but left as they were youngsters. So when they did their formal immigration, they were added to the immigration list. In the old rules, when father, then who was the South African, passed on, they could take their money out of the country, provided we could show that father had formally immigrated. Now, recently, we see the authorized dealers. That's a big bank, to be honest, and for everybody to understand. An authorized dealer is your typical big 4 or 5 banks. They now expect that child with a South African ID number that left before he was, so his parents left when he was a youngster, or some of them were born, say, in America. Now, suddenly that money must be paid into a local bank account, and that youngster has to come and register as a taxpayer in South Africa. Not a tax resident, just a taxpayer. So they're now forced to go through a process as if they lived in South Africa. Because in the old days, immigration, and if your father then formally immigrated, your inheritance could leave. Now, unfortunately, the Reserve Bank guidance is so unclear that authorized dealers are so scared they insist that the money be paid into a local bank account. The minute it's in a local bank account, I need a tax number, I need a tax clearance certificate, and that's a tax immigration clearance certificate to get your capital out of the country.
So for those South Africans, wishing to emigrate for exchange control purposes, often referred to as, financial emigration, do the tax laws apply in that particular instance?
Well, financial immigration as such has been switched off. 28th of February was the last time you can apply. So unfortunately now everybody is equal. Anyone with a South African ID has to follow a tax process. So Reserve Bank has handed over the transfer and the approval of transfer of money to the receiver of revenue. So everything is now a SARS process. So no more financial immigration for those guys. And even people who have financially immigrated or formally immigrated, the correct term, have lost their constitutional right to transfer money freely. So it's an interesting thing. It was never part of the announcement that the minister made a few years back in Parliament saying that formal immigration will be switched off. No one told these people that formally immigrated and their siblings, I call it the second generation in my article, no one warned them that they will now be treated as if they are tax resident. They are now therefore, interesting, all laws in our country says you are innocent until proven guilty. In tax law, you're deemed to be a resident until you have shown to SARS and obtained a tax immigration clearance. This was not warned to the expats. And when I'm saying expats, I'm talking about second generation, people who have probably never lived in this country, but because of our constitution, they're entitled to a South African ID number. They are now equal to those people who lived in South Africa all their lives.
So under the new laws, does a person have to be a South African tax resident to access their retirement funds?
No, they have to be actually out of the country for 3+ years.
Okay.
So those people who are left, the first generation, they should have been out 3 years. We have told SARS, it's a very confusing word, years. The tax law refers to 3 years. There's no definition like years in the tax law, funny enough. We have definitions that indicate that a year is a year of assessment. So we assume it's 3 years of assessment. We're busy with that process. That is working quite well. It took them a lot of time. They were told in February of 2020. It's changing. They changed the system 26th of February, 26th of April. They had to switch it off and restart on the 3rd of May. But I must say, since the 3rd of May, we've had very little problems. So now it's working for everyone who has left South Africa 3 or more tax years. They can now cash out their retirement annuity. No need to block their bank accounts or anything like that on a banking level, purely a tax level. They must prove to SARS they've been out 3 years. They still remain outside of South Africa 3 years. That means they also have to update their banks on the voluntary common reporting standard, voluntary disclosure to say, I'm now a tax resident in a foreign country.
So what if they cease to be a tax resident in South Africa and emigrate to other countries, but then they leave their assets such as property behind, still in their name? Will they still be liable to pay tax?
Absolutely. So that property, so we still have what we call situs tax or source rules. If there's a immovable property in South Africa, SARS will keep on taxing you on the rental income. And even if you have tax immigrated or formally immigrated, that's always been the rule. You will pay capital gains tax on the day you sell that property. If that property is worth more than 2 million rand, then there's a withholding tax on the capital gains tax. So if you and your wife owned it jointly, that amount, the monetary amount jumps to 4 million, then there's a withholding tax. So even if you have tax immigrated, SARS will still keep you tax registered in South Africa. So you change from a tax resident to a taxpayer. But now what has happened is that unfortunately, a lot of fearmongers, when expat tax started or was announced in 27, told everybody to escape expat tax, cancel your tax registration number. So a lot of South Africans canceled their tax numbers, not realizing that they still remained exposed to South African tax law on their rental income from South African property, capital gains tax from South African property, and tax on the retirement annuities when they tax. And that's an international law. That is totally acceptable. Nothing has changed. It is more the changes between financial immigration or formal immigration and tax immigration that there was no warning to the expats. And suddenly, on the 1st of March, they suddenly realized their children the second generation children, can no longer take their money out.
So should I wish to emigrate from South Africa, what would you advise me to do? Would you advise me to transfer my current pension fund to the new employer's pension when moving, between jobs? Or should I transfer the pension fund to a preservation fund, which is more financially viable?
So I'm giving you tax advice. I'm not a financial planner, not allowed to do that. From a pure tax perspective, please don't put it in a retirement fund. Do not put it in a preservation fund and take one withdrawal, because you now place yourself within the 3-year plus rule. So the easiest for anyone who is part of a normal pension fund and you plan to leave South Africa, cash out, suffer the tax, put the money in your personal name. If you want to go into a preservation fund, please do not take one withdrawal, because there's a big difference between a pure preservation, where you took 100% from your pension fund, put it into the preservation fund. You can still take that out within 1 or 2 or 3 years. But the minute you've taken one withdrawal, that preservation fund is treated like a retirement annuity, and you have to wait 3 or more years before you can take your money out. So I know the financial planners are going to hate me for this, but that is something that the government created. We are now encouraging people to take their money out of the country. The second reason why I'm saying that, again, tax. Very uncertain at this stage, but in the February budget, the Minister of Finance said that when someone leaves South Africa, they now intend to tax the remaining retirement funds in South Africa. And the reason for that is, if I, for example, left money in a retirement fund and I went to England, our double tax treaty says once I start retiring and I go into a living annuity, so I commute, then in terms of the double tax treaty with UK, Australia, New Zealand, South Africa has no taxing right. Even if you contributed and deducted your contributions from a South African tax system, once you now live in a foreign treaty country, most of the treaty countries then has the sole right to tax that. And obviously now Treasury is upset with that. And they've now made this statement during the budget speech of 2021, and no one knows where it's going. So it's causing a lot of aggression from the expats, because they all fear that SARS will now dip into their their pension fund. So we don't know, are they going to wait until you retire? Are they going to dip in while you're still unretired, so you're still contributing, because a lot of people are tax non-resident because of a treaty, but they're still contributing because they know they're coming back. So it's a real big confusion. What is going to happen with retirement funds? That's sacred funds. Governments' continued policy-making statements about pension funds unfortunately makes people very jittery. And now, and again, I'm saying from a pure tax point of view, if you ask me, cash out, because pay the tax now before they dip into it and tax it.
I'm actually glad you touched on the double taxation treaty network. So as a non-resident, for tax purposes, can I cash in my living annuity if I want to leave South Africa?
Not, unfortunately not. Once you have commuted or you're in a living annuity, you cannot do that. Some countries has the right to tax you, and South Africa have to give you exemption, and very onerous provision, but you have to then prove that you have shown to your foreign country that you're earning the South African living annuity or pension. And then once they have stamped that form, SARS will issue a directive to the pension fund in South Africa, stop deducting the pay as you earn, but unfortunately you cannot cash it in. So you can only encash a retirement annuity prior to your commutation date or prior to you starting to get benefits.
You know, Hugo, you're raising very pertinent points here, and we really appreciate that. But why is it so crucial to obtain expert advice before seizing South African tax residency?
Well, let me give you an example. If you want to go, for example, to a country like Australia or Portugal or Spain, where you need to have cash and pay to get a property or invest in the government bonds of their country, you need your cash upfront to get the what we call investor visas. So there's a lot of criticism about investor visas, but they are the reality of the world. It is your soft landing in a new country. So when people come to me and they say, I'm planning to leave, the first thing I look at is what is the cash available. And if they have a pension fund that they're contributing, I'm saying cash out. Resign, cash out. That is your easiest cash after tax to pay for your golden visa to Portugal. Because if you do not do that before you leave, then you are suddenly stuck for 3.5 calendar years before you can get your money out. So this new policy of government and National Treasury specifically has really, I think, hurt a lot of fund managers, because we are now, as tax advisors and immigration consultants, are saying to people, there's no incentive to leave your money in this country. If you want the cash, take it out before you leave South Africa. Sadly, that's the facts.
And when should tax emigration be reported?
Very quickly, once you have left South Africa. So it all depends on the treaty country. If we look at the UK, it could be within 45 days of arriving. And the UK say the longest can be 183 days in their tax year. So their tax year is 5th of April, ours are 28th of February. So on the 6th of April of this year, to look at that practical, if you were then in the UK 183 days, that's the longest term it takes to become a tax resident, then on the 5th of April, you are deemed to be tax resident in the UK from the 6th of April 2020. They take it right 1 year back. So you should have told SARS by end of February by paying your exit tax. If you look at America, it takes 3 years once you arrive there on a normal visa. But again, if you were EB5 or you won the lottery and you're a green card, then it's immediately. Australia, It's only when you have a permanent residency. So each country differs, but the principle is you must tell SARS and your banks common reporting standards the minute you know that you now qualify to immigrate from South Africa, or the term is cease to be a tax resident.
All right, Hugo, great chatting to you. Thank you so much for sharing your valuable insights with us.